Hello, I want to welcome you to this training. Today, we're looking at the topic developing your personal forex trading strategy. And I'm your host. My name is Rotimi Olawale. Let's get started. What is a forex trading strategy? Now, for most traders, when you start trading, most likely you're going to be using another person's strategy. But do you know that over time, with experience, you can actually develop your own trading strategy to suit your personality and your trading style. And that's what we aim to show you in this video. So again, what is a forex trading strategy? A forex trading strategy is a systematic plan that is used to determine when to buy or sell a currency pair in the forex market. It's a set of rules that shows you the appropriate time to execute a trade, set your take profit, your stop loss, or exit the trade as at when due, for that particular trade. And we said that it guides traders on the best time frame to enter and exit trades. Now, as a trader, over time you get to know the kind of trader you are, either you're a scalper, a day trader, a swing trader, or a position trader. And there are specific time frame for each of these trading style. So your strategy will also be developed in such a way that it caters towards the kind of trader you are, either you are a scalper, day trader, swing, or position trader. And it also will help you to know how much to risk on your account and the method of managing your trades. Now, another thing you need to note about your trading strategy is that it typically includes specific indicators. Over time, you might have discovered some indicators that work for you. Probably it's RSI or moving average or stochastics. And you can also, add your risk management tools and you can make everything to align with your particular trading style or even specific time frame that works for you as a trader. Now, there are different types of trading strategies. I want to briefly look at each of them. Number one is what we call the trend following strategy. And we see that this involves identifying a currency pair's general direction. Now, generally, price in the forex market is either in an uptrend, downtrend, or in some instances, price could be sideways. So for a trend following system, it means you are specifically following the trend of the market that is taking trades in the direction of the market. So when the market is in an uptrend, it means you are taking bullish trades. And when the market is in a downtrend, you're taking bearish trades. So that way you're doing trend following. So in such instances, you may add indicators like moving averages or trend lines, to confirm your trend for a trend following strategy. Another type of trading strategy is what we call the range trading. And we say that in range trading, traders look for currency pairs that are moving within a set price range and trade within a support and resistance levels of that range. Usually when we have a range means that price is bound between two parallel lines where the upper part is the resistance while the lower part is the support. So you can use this as a trading strategy. As price bounces between this resistance and support, you can pick your trade. I would say that this strategy often suits markets that lack strong trends. The third type of strategy we have here is called the breakout strategy. And this strategy involves waiting for a currency pair to break out of a defined range or key level and then trading in the direction of the breakout. And it's often used when anticipating strong price moves after consolidation. So what happens is that there are times in the market when market is in the consolidation state, that is, the market is consolidating, is in a range. And after a consolidation, most of the time may end up with a breakout. So during a breakout, price breaks above key levels, above or below, breaks out of key levels and may go several hundred pips, in some instances, giving you an opportunity to trade in that direction and making profit in the market. Then the fourth one here is called the carry trade. And this involves borrowing in a currency with a low interest rate and investing one with a higher rate, aiming to profit from the difference in interest rates. So this typically is you trying to profit from the difference in interest rate of a particular currency pair. And carry trades are influenced by interest rate differential between countries. The fifth one here is what we call the news trading. And we say that traders who use this strategy focus on the economic calendar and major financial news events. Now, there are key events that are released every month, predetermined events. You can check the website forexfactory.com to get more information on news trading and specific news that are released from different countries around the world. But key news that events that usually, that could be volatile and tradable, you have events like GDP, the employment change like NFP, consumer bank interest, and retail sales, and so on and so forth. Now, these events cause a lot of volatility in the market. So what happens is that traders try to capture the movement of these news when they are released. When the data comes out good for the currency, there's a tendency for that currency pair to go bullish, and that can lead to trading in that direction for massive opportunity. Or when the news comes out against that currency pair, when the news is not too good for that currency, it leads to the weakening of that currency, in which the currency goes in the bearish direction, where you can also pick bearish trade and make a lot of profit. Sometimes the news, when this data is released, the news can just spike up within a few minutes, and sometimes the trend of that, the effect of that news can last for days, weeks, or months. Depending on the kind of news it is. So traders do take advantage of news trading, to trade the market and make massive profit. Also, we have scalping. So scalpers aim to make quick, small profits throughout the day by exploiting minor price changes. Now, scalpers are short-term traders. They look for short movements in the market, and usually they trade on 1 minute or 5 minute time frame using technical indicators. So scalpers just pick some few pips around 5, maximum 10 pips, and they're out of the market, and they can repeat that many times within the trading day. And final one we have here is the swing trading. So we see that swing traders focus on capturing short to medium term moves by holding position over days to weeks. Swing trading is a kind of a relaxed way of trading where you look at most of the time the medium term direction of the market, and your trade can run from a few days to weeks. Profit potential can be in the range of 50 to 150 pips, and market goes in that direction often based after proper analysis. So we say that they use technical analysis to find entry and exit points, looking to capture swings in price. And this kind of trading can actually be advisable for people who probably have a day job and you don't have the time to sit behind the system every day, doing day trading or scalping. Then you may consider swing trading because it can just be good for you. So it should be noted that each trading strategy requires discipline, practice, and a good understanding of the Forex market. So we're not saying that just using the strategy alone will give you profit, but you need to also practice discipline. Discipline is very essential in Forex trading, and an understanding of the market also is very important. And traders do adapt strategies to fit their goals. So you make a strategy to fit your personal goal, and also your time commitment. Time commitment talks about the time you are willing to be available, to utilize a strategy. So if you know you're going to be busy by your schedule, then you look for a strategy that you can, that will give you more time for you to trade the market instead of using a short-term strategy where you will not be available, to trade the market. And also need to consider your risk tolerance. This varies from one individual to the other, but risk tolerance is also a key factor to consider. Now we go to the other point here, and that's how to develop your personal trading strategy. And the first point here is that you need to define your trading goal and your trading style. So the first question is, what is your goal in trading? So you need to define what you aim to achieve with Forex trading. Are you looking for long-term growth or quick gains? Are you looking for a get-rich-quick scheme, or you want to be here for the long term? You need to clearly define these goals before you set out, designing your strategy. So we say that having a clear end goal will guide your strategy, helping you choose the appropriate trading style, time commitment, and risk tolerance. Number two here, determine your trading style. Choose a trading style that suits your lifestyle, your psychology, and your availability. And I would say also choose a trading style that suits your personality. We all have different personality as individuals. So you need to choose a trading style that suits your individual personality. So we say that styles include day trading, swing trading, scalping, and position trading. For instance, if you can't monitor trades constantly, swing or position trading may suit you better than day trading or scalping. So determine your trading style. Number three, analyze your risk tolerance. Your risk tolerance will dictate your position sizes, stop loss levels, and leverage. Now, like I said earlier, our risk tolerance varies as individuals. Some people have a high risk tolerance while some have low risk tolerance. So you need to understand yourself and include that in your trading strategy. If you know your risk tolerance is on the high side, well, that should shape how you design your strategy. And if it's on the low side, that should also determine how your strategy works. So we say that by understanding how much risk you are comfortable taking on each trade, you can avoid overextending and make trading decisions that align with your comfort level. Always trade in line with your individual comfort level. Number four, choose a market. Focus on specific currency pairs that you understand and have studied. Choose a market you want to trade in. Either you want to trade in currencies or commodities or cryptocurrency, you know, and so on, or stocks, whichever one you've chosen, or indices. Choose a market that you're comfortable with. Now, let's assume you're choosing the currency market. It's still advisable you also select individual currency pairs that you understand. Now, each currency pair do have their individual characteristics. So you need to also know the characteristics of the currency pair you want to trade. So we say that this could mean major pairs like Euro USD or GBP USD, which tend to be less volatile, or minor pairs that may have higher volatility. Consistency in the pairs you trade can enhance your familiarity and intuition for the market. So if you understand the currency pair you're trading, it can go a long way in helping you to determine how that currency moves in the market and how that can help you, to get better trading opportunities with your strategy. Develop your entry and exit rules. Define the technical or fundamental signals that trigger your trades. Entry and exit rules might include chart patterns, indicator levels, or news events. Being consistent with these rules reduces impulsive trading and make it easier to evaluate your strategy's performance. Now, this is very crucial. You need to determine your entry and exit rules. What are you looking at that determines it's time for you to enter into a trade? Are you seeing a specific chart pattern, like a head and shoulder pattern, or you're looking at an indicator like RSI, looking at maybe it's overbought or oversold, or it's at 50 level? This should be, the determinant of your entry, or you are looking at your entry based on news. And for your exit rule, also determine specific, exit rules for your trade. This is very, very crucial in determining how your strategy work. Number six, create a risk management plan. Effective risk management protects you from significant losses. That's very important. Effective risk management protects you from significant losses. A key principle here is to limit your risk per trade, often around 1 to 2% of your trading capital. And this is a professional advice when it comes to risk management. Never risk more than 1 to 2% of your equity, per trade that you take. Now, incorporating stop loss orders, position sizing, and profit targets can help secure consistent gains while managing losses. Number seven, test your strategy through backtesting and demo trading. Backtesting involves analyzing historical data to see how your strategy would have performed in past market conditions. Now, when you get on your MetaTrader platform, either MetaTrader 4 or MetaTrader 5, you can go back in history, by dragging the charts backwards to many years, 5 years, 10 years, 15 years, and more to see if that strategy had worked in the past. Now, doing that is what is called backtesting, going back in history, checking historical data to see how your strategy had performed in the past. That's what we call backtesting. Now, after you have done backtesting of your strategy, if it had worked 5 years ago, 10 years ago, there's a high tendency it's still going to work today. So after you've done backtesting, then the next thing now is that you now do what is called demo trading. That is trading that same strategy now, but on a demo account, not a real account. So if your strategy had worked in the last 5 years, 10 years, 15 years, there's a high tendency it's going to work today if you practice it again on a demo account. So demo trading lets you test your approach in real time without risking actual funds. This helps you refine your strategy and adjust before committing real money. That is before trading it on live. Trade that strategy on demo first. Number 8, keep a trading journal. Record each trade, including details like entry and exit points, rationale, and outcome. Keep a trading journal. In your trading journal, you're putting down the reasons why you're entering a trade, why you're also exiting the trade. And you can always go back to check it later on to see how successful your trades have been. So if you had a winning trade, you know the reason why it was a winning trade because you put it down in your journal. And if it was a losing trade, you will also know, you can really track how your progress is by having a trading journal. So we say that reviewing your journal helps you identify successful patterns and mistakes, improving your strategy and discipline over time. Number 9, stay updated with market news and economic indicators. Forex markets are heavily influenced by economic events like interest rate decisions, unemployment reports, and geopolitical events. For example, just last week, the United States had its election, where the current president now, Donald Trump won. And during the course of that election, there was a lot of volatility in the market. So that's why you need to stay updated with market news and economic conditions. Staying informed helps you make better decisions and anticipate potential market moving events. And finally, number 10, regularly review and refine your strategy. Markets evolve, and so should your strategy. The truth is that the market is never constant. The market is always dynamic. It's always ever moving. It's always evolving, and so should your strategy. Regularly evaluate your performance to identify areas of improvement. If a tactic isn't working, adjust it to better suit current conditions or your trading goals. Flexibility and adaptability are essential for long-term success. All right, so that will be the end of this training on how to, put together your own trading strategy as a forex trader. I hope you've enjoyed and learned one or two things from this strategy. That'll be all for now. Bye-bye.